Yes, it's actually true that some people have even asked, is a non-QM type of a loan even a good idea? Well, I guess the way I would answer that, and I'm trying not to chuckle too much, is, well, of course it is. You have to consider that the non-QM type of a mortgage program, again, this serves a segment of the population who have essentially alternative lifestyles as it relates to business, work, employment, income from your job. These are folks who, in many cases, are quite successful, but they've chosen a different path in terms of operating a business or working than a majority of the population. And so the conforming guidelines, these are guidelines that conform to the two quasi federal mortgage agencies, Fannie Mae and Freddie Mac. Um, a majority of the population can qualify based on those conforming guidelines. We determine, your employment history. We establish that you have a recurring monthly stable income that can be expected to go on for 2 or 3 years, and you have a history to prove it. You actually are able to meet a qualifying debt ratio when taking into account your pay stubs, your W-2s, and even your tax returns. But again, in a lot of cases, there are borrowers out there who are just as worthy of getting mortgage financing to own a home who don't fit that particular profile, that mold. And so this segment was developed to address that underserved segment of the market. So, of course, it's a good idea to have non QM loans. These loans are reasonably priced, relatively speaking. Yes, you're going to have a higher rate than a conforming loan, Fannie Mae, Freddie Mac, FHA, VA, USDA. Yes, you're going to have a higher down payment requirement, typically 15% or more, some rare cases 10%, but I would say as a whole 15% or more. You are going to be experiencing a higher interest rate than a conforming loan.